Hey there, and welcome to This Explainer. Today we're going to dive into the exact strategic shift that turned a shy kid from Omaha into a $100 billion titan. We're talking, of course, about Warren Buffett. But you know what makes his story so incredibly unique among the ultra-wealthy is that he didn't inherit a vast fortune, and he didn't invent some revolutionary piece of technology. Instead, he grew his wealth by consistently winning in the stock market. So today, we're going to unpack the specific structural evolution of his investing strategy to see exactly how he did it.
Okay, let's kick things off with Buffett's most famous yet seemingly simple investing rule. The first rule of investment is don't lose. Now, at face value, that sounds almost too obvious, right? Like, of course you don't want to lose. But for Buffett, this wasn't just a catchy soundbite. It was a deeply ingrained philosophy born out of watching the severe economic struggles of the Great Depression during his childhood.
And his follow-up rule brilliantly illustrates his early, ultra-conservative approach to the stock market. Rule number 2, don't forget the first rule. His core belief was that if you buy things for far below what they're actually worth, and you buy a whole group of them, you basically insulate yourself from losing money. You're essentially building a rock-solid floor beneath your investments. So here's the billion-dollar question we have to answer. How exactly did he scale such a cautious, defensive philosophy into unparalleled wealth without inventing a single new thing? I mean, how do you take a mindset based entirely on not losing and turn it into the ultimate winning streak? To answer that, we have to look at where his strategy started. Section 1, the baseline, cigar butt investing. To understand his ultimate success, we first have to look at this baseline strategy, which he learned from his Columbia Business School mentor, Benjamin Graham. Graham taught young Buffett what he called the cigar butt method. Imagine walking down the street and seeing a discarded cigar butt on the sidewalk. It's ugly, it's soggy, nobody wants it. But there is still one free puff left in it. Buffett literally took this philosophy to the extreme. He went hunting for terribly performing, nearly bankrupt companies, selling for so incredibly cheap that even their underlying liquidation value was worth more than the stock price. You buy it, you take your one risk-free puff of profit, and you throw it away. And what's really wild is how incredibly successful this gritty strategy was right out of the gate. In 1956, at just 25 years old, Buffett started a partnership with about $100,000 from friends and family, operating totally alone out of his bedroom, writing checks, filing taxes, looking like a teenager. He used this cigar butt strategy to outrun the market by a factor of 4. He grew that initial venture into a $7.2 million foundation in just 6 years. Part 2, the trap, the Berkshire Hathaway mistake. Because as the market boomed and stocks became overvalued, those cigar butts completely dried up. And this is exactly where Buffett fell into a trap born out of pure frustration. This sequence of events is just crazy. A spiteful 13-cent disagreement over a textile mill deal is what left him accidentally stuck with a declining, failing business. Berkshire Hathaway was a classic cigar butt. The stock was at $7.50, but the assets were worth at least $11. He was ready to take his free puff and agreed to sell his shares back to the owner for $11.50. But then, the owner tried to nickel and dime him, sending an official offer of $11.37 instead. Infuriated by this, Buffett actually bought the entire company just so he could fire that owner. He got his revenge, sure, but the aftermath was pretty grim. The crucial lesson he realized here was that buying cheap, dying companies out of spite was a terrible foundation for long-term growth. He was now the proud owner of a failing textile company in a declining industry. It turns out you simply cannot scale your wealth to $1 billion on the back of a business that is inherently destined to fail, no matter how cheaply you bought it. Section 3, the shift. Discovering the economic moat. This crisis forced a complete top-to-bottom rethinking of his investment strategy, sparked heavily by a conversation with his brilliant business partner, Charlie Munger. Charlie Munger essentially triggered a massive paradigm shift. They realized they had to stop hunting for fair or even failing companies at bargain basement prices. Instead, the strategy completely flipped. They needed to focus entirely on buying great, high-quality companies at fair prices. And that brings us to his absolute secret weapon, the economic moat. If you're going to buy a great company, you need a metric to define what makes it great, right? Well, Buffett decided that the defining characteristic of a great business is its moat. Just like a medieval castle is protected by a wide ditch of water, a great business is protected by a structural advantage that strictly prevents competitors from stealing its market share. Take Coca-Cola, for example. It is the perfect illustration of a moat. Think about it. Coca-Cola has been around for over a century.
It's a brand that intimately connects with billions of people globally. If you try to start a soft drink company today, no matter how amazing your soda tastes, you are up against a level of brand dominance that makes it nearly impossible to compete. That right there is a massive and penetrable economic moat.
Part 4. The engine, fueling the moat. Okay, so Buffett now knew exactly what to buy, companies with deep economic moats. But to build an empire, he needed a way to constantly fund these massive acquisitions. And moat-protected companies, they are not cheap. He needed a serious cash engine.
And he found that engine in the insurance business. You see, traditional companies have to constantly reinvest their profits just to survive. But insurance companies, they operate much more like banks. People regularly pay their insurance premiums up front, meaning these companies are sitting on massive piles of cash, which is called the float, long before they ever have to actually pay out a claim. Buffett realized this was quite literally a mountain of usable cash just waiting to be invested. So he executed this aggressively. Starting in 1967, he began buying up insurance businesses left and right, National Indemnity, Central States Indemnity, and eventually Geico. By taking control of these insurance companies, he effectively capped into billions of dollars of cash flow that he could deploy whenever he saw a great company trading at a fair price. He used this massive insurance float to execute his master plan. He completely phased Berkshire Hathaway out of the dying textile industry and transformed it into a powerful holding company. Armed with all that insurance cash, he went on a massive shopping spree for grade A businesses protected by economic moats. He acquired a staggering 7% of Coca-Cola's total stock, along with massive chunks of American Express and the Washington Post.
Section 5. The ultimate wealth formula. So what actually happens when you synthesize these two brilliant structural realizations? What happens when you combine the infinite cash engine of an insurance float with the impenetrable defensive walls of an economic moat?
Well, the compounding effect is absolutely staggering. By 1990, Berkshire Hathaway's stock price didn't just grow, it completely skyrocketed. Remember, this was a stock trading at just $11 a share back in 1965. By 1990, it was trading at an astonishing $7,000 a share. And obviously, this specific strategy propelled Buffett's personal net worth straight into the stratosphere. He went from a highly successful $25 million net worth in his late 30s to crossing the billion-dollar mark by age 60. And by 2008, simply holding fast to his principles of finding moats and letting them compound, he was literally crowned the richest man on earth. But you know what's so endlessly fascinating about this story? This financial titan remains famously, almost comically frugal. We're talking about a multi-billionaire who drives a 2014 Cadillac and frequently grabs a simple McDonald's breakfast on his way to work. It beautifully illustrates that his incredible wealth wasn't built out of a desire for flash or luxury. It was built strictly on a deep, fundamental understanding of structural investing principles and having the discipline to stick to them. Which leaves us with a critical thought to apply to our own financial journeys. Now, we aren't all going to go out and buy insurance companies tomorrow, but the core concept of the moat, that is absolutely timeless. In a world of constant technological change and rapidly shifting consumer habits, where are the unbreakable moats being built today? Finding the answer to that question might just be your very first step toward building your own enduring wealth. Thanks so much for joining me on this explainer, and keep looking for those moats.